Nevada was built on the idea that smart money always wins. For years, investors treated this state as a guaranteed return. Low taxes, no state income tax, tourism dollars flowing year-round. A parade of California migrants pushing prices higher every quarter. Buy in Nevada, hold it, watch it appreciate. That formula drove investors to purchase approximately 131,710 homes in the Las Vegas Valley alone since the year 2000, according to data cited by Rice Las Vegas. They drove investor ownership in Nevada to 24.84% of all single-family homes, the seventh highest share of any state in the nation. In Las Vegas specifically, investors own 26.29% of all single-family homes, about 172,000 properties, well above the national average of just 2%. That was the bet. And now, across 8 Nevada cities, the data shows investors are quietly but unmistakably walking away from it. According to Redfin's December 2025 analysis, investor purchases of Las Vegas homes fell 20% year-over-year in Q3 2025, the largest drop of any major metro in the entire country. According to the Batch Data Q3 25 Investor Pulse Report, Q3 2025 was the 7th consecutive quarter where the largest investors sold more properties, 5,798, than they bought, 4,663. 7 straight quarters of net selling. That is not a temporary pause, that is a structural exit. Today, Discover the States reveals the 8 Nevada cities where that exit is happening, and what it means for every homeowner who remains. City number 8, Laughlin. Laughlin was never the glamorous bet. That was always part of its appeal. While Las Vegas drew the high rollers and Reno courted the tech converts, Laughlin offered something quieter: a Colorado River escape for retirees, budget travelers, and small investors who believed affordability and modest appreciation could coexist peacefully. That piece is breaking. The investor logic in Laughlin was always tied to its tourism economy: short-term rentals, vacation homes, and modest cash flow properties serving the casino corridor's seasonal visitors. But according to 702 Housing's 2025-2026 Nevada market analysis, visitor numbers and convention traffic across southern Nevada declined 7.4% in 2025. Tourism is the engine that justifies investor presence in a market like Laughlin. When that engine slows, the math that brought investors here reverses fast. According to Inago's Nevada housing market forecast, Laughlin carries specific projected price declines alongside other southern Nevada markets, flagged explicitly in Norada Real Estate's Nevada City by City Forecast as a market where values are expected to decline rather than appreciate through 2026. Homes are staying on the market longer. Rental income projections are softening as visitor traffic thins. And the investor who once calculated a comfortable cash flow margin is now staring at a spreadsheet where the numbers no longer work. Laughlin doesn't collapse loudly. It empties quietly. The investors who arrived loudly with confident return projections leave the same way, one listing at a time, without announcement, without fanfare. And the homeowners who remain discover what it means to sell in a market where the buyers who once competed for properties are now the sellers. City number 7, Elko. Elko sits in northeastern Nevada, far from the casino corridors and tech campuses that dominate the state's housing narrative. Its economy runs on something older and more fundamental: gold mining. And for years, that made it a different kind of investor opportunity. When commodity prices rose, Elko boomed. Workers arrived. Rental demand surged. Investors who understood the mining cycle bought properties here to capture the income those workers needed to spend. It was a niche bet, but a real one. According to Norada Real Estate's Nevada housing forecast, Elko is among the only markets in the state projected to see stable or slightly positive price trends through mid-2026, a distinction that separates it from the broader Nevada decline. But the investor story here is more nuanced than that projection suggests. According to Batch Data's Q3 2025 Investor Pulse Report, the largest institutional investors in Nevada have been in net selling mode for 7 consecutive quarters statewide. In a market like Elko, where the investor thesis depends entirely on mining employment cycles and commodity price stability, that broader institutional retreat matters. When large investors exit, they flood local markets with inventory that smaller buyers and local investors cannot easily absorb. Elko's mining-dependent economy creates the same vulnerability that has historically defined single-industry Nevada towns. when gold prices shift, when mining operations slow, when the workers who justified the rental market stop arriving. The investor math collapses with the same speed it was built. And the for sale signs that follow are not signals of market strength. They are signals of capital looking for its next exit. City number 6, Carson City. Carson City built its investor appeal on a narrative of stability. The state capital, government employment, a slower, more reliable market than the volatility of Las Vegas. A haven for investors who wanted Nevada's tax advantages without the boom-bust cycles of a tourism-dependent city. That narrative of stability is now being tested by the same forces reshaping every Nevada market. According to Inago's Nevada Housing Market Update, Carson City's average rent sits at approximately $1,800 per month, up just 1.0% year-over-year, in a market where mortgage rates hover around 6.8% to 6.9% according to the same Intempus Property Management Fall 2025 report, and where investor purchase prices in Nevada averaged $412,517 in Q3 2025, according to batch data. The monthly carrying cost of an investment property versus the rent it generates creates a return equation that is increasingly difficult to justify. Here is the core investor problem in Carson City. Government employment provides consistency, but it does not generate the population growth that drives rental rate appreciation. According to Batch Data's Q3 2025 data, 40% of investor sales in Nevada are to other investors. When investor-to-investor transactions dominate a market, it signals that traditional owner-occupant demand has weakened. The market is circulating within its own ecosystem, investors selling to investors rather than cycling properties to the end users who would sustain long-term price support. According to Nevada's Q1 2026 ATM data, 1 in every 1,983 Nevada homes received a foreclosure, filing the second highest state foreclosure rate in the country. In Carson City, where investors who bought at 2021 and 2022 prices with short-term assumptions are now confronting a market of flat rents, high carrying costs, and weakening resale demand, that foreclosure pressure is not abstract. It is building. City number 5, Sparks. Sparks was sold to investors as Reno's growth engine. Industrial parks, logistics hubs, Tesla's gigafactory, creating ripple effects across the entire northern Nevada employment base. The promise was straightforward. The jobs are coming, the workers need housing, and investors who position early will capture the returns. The data shows the positioning has become a problem. According to Inago's Nevada Housing Market Analysis, Reno's median home sale price sits at $513,000 in January 2026, a market where investor purchase prices in Q3 2025 averaged $412,517 according to batch data. In Sparks, where prices ran up dramatically from the industrial growth narrative, investors who bought at or near the peak are now sitting in properties where the rental income versus carrying cost calculation has deteriorated. According to the Norada Real Estate Las Vegas forecast, which tracks the broader Nevada investor trend, investor activity peaked in Q2 2022 with 4,229 homes acquired in a single quarter. By Q3 2025, that pace had collapsed dramatically, with Redfin documenting the 20% year-over-year decline in Las Vegas investor purchases, representing the largest drop of any major metro in the nation. The same forces operating in Las Vegas, rising carrying costs, softening rental income, slowing appreciation, are operating across the Reno Sparks corridor. According to batch data, the largest investors have been net sellers for 7 consecutive quarters. In Sparks, where the growth narrative attracted investors who expected rapid appreciation to compensate for thin initial cash flow, the decision to sell rather than hold has become increasingly rational. The jobs that were supposed to fill these neighborhoods have not arrived in sufficient numbers to sustain the pricing that pandemic-era speculation built, and the investors who built portfolios on that expectation are now quietly listing what they cannot afford to hold. City number 4, North Las Vegas. North Las Vegas was marketed as the affordable frontier of the Las Vegas metro. Lower entry prices, strong rental demand from working-class families, and military personnel near Nellis Air Force Base. A growing city with room to expand that the more expensive parts of Clark County no longer offered. Investors arrived in numbers. The data shows they are now leaving in numbers. According to Clark County data reported by the Las Vegas Review-Journal, home sales across Clark County dropped 10% in 2025. North Las Vegas, positioned as the entry-level and investor-friendly segment of the metro, felt that decline directly. Zumper's December 2025 report showed one-bedroom rental prices down in every Las Vegas Valley enclave, with Paradise seeing the sharpest drop at 14.3% year-over-year. Across the valley, rental softness is most acute in the affordable segments, where North Las Vegas investors concentrated. Here is the specific North Las Vegas investor problem. The short-term rental market, which many investors use to justify purchase prices above what traditional long-term rents could support, is being squeezed by both regulation and declining tourism. According to the Nevada Independent's December 2025 reporting, Nevada lawmakers have repeatedly attempted to cap corporate home buying. SB 10, which would have limited corporations to purchasing 1,000 homes, annually failed by a single vote in the November 2025 special session. The political pressure on investor ownership in Nevada is building, and investors who monitor regulatory risk are factoring that uncertainty into their hold versus sell decisions. According to UNV researchers cited by the Nevada Independent, investors have been buying an average of 6,700 Vegas Valley homes annually over the past 15 years. The two largest residential property owners in all of Southern Nevada are institutional investors: Pretium, based in New York, and Invitation Homes, based in Texas. When New York and Texas institutions decide Nevada's return profile no longer justifies their capital allocation, the inventory they hold does not disappear quietly. It floods listings. And in North Las Vegas, where that institutional footprint is concentrated in the affordable segment, a wave of institutional selling hits the market that the city's owner-occupant buyer pool is not large enough to absorb. City number 3, Henderson. Henderson was supposed to be Nevada's safest investor bet. Wealthier residents, higher household incomes, master-planned communities with strong school ratings and low crime. The city that other Clark County markets aspired to become. The 2025 data is not kind to that assumption. According to the Las Vegas Review-Journal's December 2025 reporting, Henderson had a down year for real estate in 2025 compared to 2024, despite the median home sale price rising 4% year-over-year. The apparent contradiction: price is up, but the year described as down reveals what is actually happening. Sales volume declined. Transaction activity weakened. The market is being propped up by constrained inventory, not by genuine demand strength. According to 702 Housing's market analysis, Henderson's average rent sits at approximately $2,200 per month, up just 0.5% year-over-year. In a master-planned community, where the homes that investors purchased in 2021 and 2022 carry mortgage payments that assumed either stronger appreciation or higher rental income, a 0.5% annual rent increase against 6.8% to 6.9% mortgage rates creates a cash flow deficit that investor portfolios cannot sustain indefinitely. According to Batchdata's Q3 2025 Investor Pulse report, 40% of Nevada investor sales are to other investors. In Henderson, where the premium community positioning attracts investors who paid premium prices, that investor-to-investor circulation is a warning signal. When properties cycle from one investor to another without reaching owner-occupant buyers, it signals that the market has become dependent on speculative activity rather than genuine housing demand from people who intend to live there. Henderson is not in freefall, but the investor confidence that sustained its recent appreciation is quietly retreating, and the market is beginning to discover what its prices look like without that speculative support beneath them. City number 2, Reno. Reno's reinvention was one of the most compelling American city stories of the past decade. Gaming town turned tech hub. Tesla, Google, Amazon. Silicon Valley refugees arriving with Bay Area equity, buying Reno properties that felt like a bargain by comparison. The biggest little city in the world was suddenly the most interesting real estate market in northern Nevada. The investor exodus from Reno is now documented in specific, unambiguous data. According to this is Reno's January 2026 analysis of the Batchdata Q3 2025 Investor Pulse report. Investors own 23.17% of all single-family homes in Reno, approximately 43,000 properties. That concentration was built during the years of rapid appreciation and strong rental demand from tech workers and California migrants. But the migration engine is cooling. According to Kinney and Renwick team's January 2026 Reno market analysis, the primary competition for Reno buyers now comes from California relocators who have sold homes and arrive with cash or equity. The organic, income-driven demand from workers being hired locally, the demand that sustains long-term rental income for investors, is more constrained as tech hiring has slowed from its pandemic-era pace. According to batch data, Q3 2025 was the 7th consecutive quarter where the largest institutional investors sold more properties than they bought across the state. In Reno, where investor ownership at 23.17% represents a substantial market share, that institutional retreat creates real inventory pressure. When large owners sell, they do not sell one property at a time. They liquidate portfolios, and portfolio liquidations, even managed, gradual ones, add supply to a market that is already seeing softening demand from traditional buyers. The Reno housing dream that investors bought into was real. The appreciation happened. But appreciation and sustainable investment returns are not the same thing. And the investors who are now selling quietly, without headlines, have made their own calculation about which side of that distinction they are on. City number 1, Las Vegas, the largest investor retreat in America. No city in America is experiencing a larger documented investor retreat right now than Las Vegas. This is not interpretation. This is the Redfin data. Investor purchases of Las Vegas homes fell 20% year over year. In Q3 2025, the largest percentage decline of any major metropolitan area in the entire United States during that period. According to Redfin's analysis, reported by the Las Vegas Review-Journal in December 2025. The numbers behind that headline are staggering in their specificity. Investors have purchased approximately 131,710 homes in the Las Vegas Valley since the year 2000. Investor activity peaked in Q2 2022 with 4,229 homes acquired in a single quarter. Investors currently account for roughly 23% of all home sales in the area, a share well above the national average. And the two largest residential property owners in all of southern Nevada are institutional investors based outside the state, entirely premium from New York, and Invitation Homes from Texas. For 7 consecutive quarters, the largest investors have sold more Nevada properties than they have purchased. 5,798 sold, 4,663 bought in Q3 2025 alone. And according to the batch data report, 40% of Nevada investor sales in that period were to other investors, meaning the properties are cycling within the investment community, rather than moving to owner-occupants who would create stable, long-term demand. Las Vegas home sales across Clark County dropped 10% in all of 2025, according to Redfin data reported by the Las Vegas Review-Journal. Realtor.com's 2026 predictions report projects Las Vegas home sales to drop a further 2.5% in 2026, with price growth of just 0.6% below the national expected average of 2.2% price growth and 1.7% sales growth. Las Vegas will underperform the nation in both price and volume metrics in 2026, according to Realtor.com's analysis. The median condo and townhome price fell 5.2% year over year to $275,000 in December 2025. One-bedroom rental prices are down in every Las Vegas Valley enclave, according to Zumper's December 2025 report, with Paradise seeing the sharpest decline at 14.3% year over year. And Nevada's foreclosure pressure remains acute, according to Adams Q1 2026 data. Nevada has the second highest foreclosure rate of any state in the country, 1 in every 1,983 homes receiving a filing. When investors who bought at peak prices face falling rents, rising carrying costs, declining appreciation, and a regulatory environment that is increasingly hostile to corporate homeownership, the calculation that led them here runs in reverse. The Nevada legislature attempted to limit corporate home buying with SB 10 in November 2025, a bill that would have capped corporate entities at 1,000 annual home purchases statewide. It failed by a single vote, according to the Nevada Independent. Governor Lombardo had previously vetoed a similar bill, citing concerns about market interference. But the political pressure is building, and institutional investors who track regulatory risk are factoring Nevada's increasingly contentious political environment into their portfolio decisions. What does all of this mean for the Las Vegas homeowner? who is not an investor. It means the 20% of your neighborhood that is owned by investors is quietly making exit calculations. It means the rental income pressure that is pushing small investors to sell is adding inventory to a market where buyer demand is already weakening. It means that when institutional owners eventually liquidate not all at once, but steadily, methodically, the supply they release will compete directly with your listing for the same shrinking pool of qualified buyers. Las Vegas was built on the belief that the house always wins. In 2026, the investors who built portfolios on that belief are quietly revising their position. 8 cities, 8 investor retreats, 1 statewide story. Let's be honest, as we always are on this channel, Nevada is not collapsing. The experts are consistent on this. Norada Real Estate does not forecast a crash. Inago's analysis describes the Nevada market as heading toward equilibrium rather than decline. A major crash like 2008, which wiped out 60% of Las Vegas home values, does not appear in any serious analyst's base case. But the investor retreat is real. The data is unambiguous. Las Vegas investor purchases down 20%, the largest metro decline in America. 7 consecutive quarters of net institutional selling statewide. Clark County sales down 10% in 2025. Condo and townhome prices down 5.2% year over year. 1-bedroom rents falling in every Las Vegas enclave. Nevada carrying the second highest foreclosure rate in the nation. And 40% of investor sales going to other investors, not to the owner-occupants, whose demand would indicate a genuinely healthy market. Investors do not run quietly without reason. They run when the math stops working, when carrying costs exceed rental income, when appreciation expectations reverse, when regulatory risk rises, when tourism, the engine that justified their Nevada thesis, declines 7.4% in a single year. The Silver State is discovering what every market eventually discovers. Capital is loyal to returns, not to cities, not to narratives, not to the stories markets tell about themselves. When the returns weaken, the capital moves, and the footprints it leaves behind are visible in exactly the 8 cities we discussed today. Housing cycles do not end quietly. They leave lasting marks. Understanding where the pressure is building is no longer optional. It is essential. Thank you for watching this in-depth report from Discover the States. If you found this analysis valuable, leave a comment with your perspective. Share this video to spread awareness, and make sure you are subscribed so you do not miss what comes next.